Okay, thanks. My name is Jon Westercamp. I'm with Appraisal Associates out of Cedar Rapids. We do quite a bit of work down the Iowa City market and specialize in valuation of multifamily income properties. So here today to kind of go through the approaches, how we value a multifamily property, going through the cost, income, and sales approach. Primarily, we'll focus on the income approach today. So if we can start here, and can I move the slides or no? See that, let me do that. Nope. Okay. So valuation process, kind of talked about there. It's very procedural. Basically, what is the value of this property at a specific point in time? It's a problem-solving process. And then, like I said earlier, in the multifamily valuation, the main approach is typically income approach. The cost approach and the sales approach get more into feasibility, because at the end of the day, you're going to look at what's this thing going to put in my pocket, and is it going to be able to service the debt, and what's going to be my cash on cash return at the end of the day. So if we go to the next slide, please. So the question we get sometimes with impacting value on a property, how can it have potentially the same property have different values? Next slide. So we look at a going concern, which would be more like a hotel, a value in use, an investment value, kind of more what we care about on the income approach side here. And then there's bonus value. And then market value. And once I said market value definitions can be different. One example would be for taxes. If you've got above or below market rents, what the rent should be and how that impacts that cash flow. Next, please. Value for eminent domain and estates, typically, a date of death, you consider an as is, where is value at that point in time. If there's some, repairs or something might be needed, or if that, values properties under rented or over rented. Like I said, kind of back to investment value on that. And then also, look at subdivisions to have a different value of, retail lots versus the discounted, modeling on that. So next slide. Start with going concern. So going concern, market value of all tangible and intangible assets of an established and operating business with indefinite life as if sold in aggregate. That doesn't really apply as much to multifamily income property. That's more, for example, like a hotel, gas station, something like that. Next slide. May or may not be value, must be based on the highest and best use. That's one disconnect sometimes appraisers have from other valuation professionals. We're bound to look at what the highest and best use of the property is. We can limit our scope and say, okay, we want to know what the value of the land is, but that's going to be very specific to values, specifically saying we are valuing just land only. There may be improvements on this, but our scope of work is to value just the land. Next slide, please. So investment value, getting a little bit closer here within income properties, specific to a buyer investor. This is the important part. And I know you guys do a lot with this too, is it gets subjective and sometimes personal, where we're looking at just numbers. And it's hard to, quantify with other people. They have an emotional attachment sometimes to real estate that, we're looking at numbers that we don't have. Example would be, an adjoining property owner. I'm sure you guys have seen this, where somebody's got a 12-plex and one comes for sale next door. They will pay a premium for that, likely because they want to be able to control it, or they may want to just assemblage of properties. So the investment value may or may not be market value, and market value is what a typical buyer and typical seller are willing to pay for a property, which is our subject where we're valuing. Next slide, please. Okay, bonus value. This is important, especially if you're looking at some of the different zonings in Iowa City and how that's changed with some of the RM44. Value of illegal non-conforming improvements, might be like a 4-bedroom or 5-bedroom that's been downzoned because maybe it doesn't meet with parking, what that extra value can bring to that property. But the bonus value is attributed to the improvements right now, because if you're looking at highest and best use of the land, if those improvements were wiped, you would not be able to rebuild that 4 or 5 bedroom. May be able to do a 2 or 3 bedroom, or with parking or, requirements with zoning, might only be a 1 or 2 bedroom. Next slide, please. So like I talked about earlier, there's 3 approaches: cost, income, and sales. Next slide. Cost approach, summation approach, basically it's a componentized approach. You look at land value, and you look at the short and long lived components. You look at your soft costs, costs in your entrepreneurial costs, or developer's profit. Add all those up, and then consider what your depreciation, whether it be physical, functional, or economic. Obviously physical is pretty easy, age of the building, if it needs a new roof, those types of things. Economic is more, hey, the markets, cost materials today are just, 20% higher, but we can't get 20% higher rent. So, we're seeing potentially economic depreciation. Or functional, you've got 5 bedroom units, and the market's, gravitating more towards 1 and 2 bedroom units. So it's harder to rent those 4s and 5s. So you're seeing, and you can't easily change that to another type of, use without major expenses that may not be feasible. Next slide, please. Okay, income approach is what we're going here for. Forecasting income, expenses, subject property based on analysis, comparable rents, if the property's above market or below market rents. I know you guys see that a lot too. If you see maybe somebody that's owned a property for 20 years, they've got it all paid for in cash. They just want to keep the thing filled up, and they're maybe rent for $500, but the market should really be $700 a month. The challenge is, taking that project to market rents. And then also considering, some of, the financial forecasts coming up with, cost of funds and how that impacts that. Next slide, please. Sales comparison approach, that can be a lot harder in Iowa City, as I'm sure you guys are aware of, with just, not a lot of properties changing hands. From an appraiser standpoint, I don't really like doing the sales approach as well in the Iowa City market, just because of the lack of sales. And, there's a lot of things playing into that, such as property rights, conditions, sale, financing terms, if there was you need to make adjustments if it was, they did a carryback, partial mortgage on, or something like that. Location, age, size, physical characteristics. Next slide, please. Okay, so gets me down to what's my property worth. As you guys know, the Iowa City market's somewhat unique. Cap rates, vacancy, just shortage supply. Look at most money income approach, like we talked about. In general, we've seen upward trends due to lack of supply. Most investors have had a long-term hold on a performing asset. The other challenge has become too, and the current market, what's your alternative investment? And that's the challenge we see with a lot of investors, that they're long-term holder. They need to maximize their profit on this, because they realize there's not going to be something as attractive to exchange into. Even in spite of some of the, which I'm sure you guys are aware of, some of the segments of the Iowa City market having some increased vacancy and challenges, we're still seeing downward trends in cap rates, in general. Next slide. So a lot of people look at, especially on, fourplexes, duplexes, gross income multipliers. I really don't like the gross income multiplier, because it's not it's not an apples to apples. Everybody can look at their gross income differently, or, per property. Hey, some of these properties, they pay water, they may pay cable and internet, the other one doesn't. And, that plays into the gross and the rent. It's really hard to extract those out, and if you do, they may be advertising this thing that's sold at a 6, and it might actually be a 7 or an 8 or a 9. Next slide, please. Okay. I like to really focus on cap rates, as most appraisers do, because it levels the playing field, because you can extract out all of the expenses on each one of them. So that way you get down to just the cap rate, and you can get rid of, like we talked about earlier with, maybe some people paying cable, some not, those types of expenses, water, heat, whatever it may be. So what we also like to look at too is we like to get at least 2 or 3 years of operating, historical income and expenses on a property. And then I typically ask the borrower too, or the buyer, whomever it may be, is there anything in this income statement that maybe should be a CapEx expense that you guys did a line item this thing, hey, did we do a new roof, or did we do half of a new roof and expense it instead of putting it on an amortization. And that's why I like looking at 2 or 3 years, because most of those things should be pretty stable through the 3-year period. We can look and say, oh wow, this is slightly different. What's going on here? And something that's helpful with you guys too, if meeting with appraisers, when you're looking at these properties, say, hey, John, this thing, they did put in some new water heaters, put in, they had 2 years, maybe some remodel. They had a couple of years of atypical high expenses, just so you're aware of that. Sometimes, appraisers don't ask that, or if they get to ask that, I always try and ask that, when I'm talking to the buyer, the broker, or whomever it is, is there anything I need to know here? Next slide, please. Okay, so talked about this a little bit earlier here, getting down to that NOI to get to that cap rate. We figure out our potential gross income of all the rent coming in. Then we consider, what a market vacancy collection loss would be. Typically what I do, especially, in the Iowa City market, since most rents are 12 months or less, we take the rents to market. Then we deduct a market vacancy. So that gets us to our effective gross income. Then next we consider management, leasing costs. Depending on the property, we see 3 to 7%. Most of them were in the 5 to 6% range. And that's one thing we see, especially some of the smaller properties. People say, well, I manage it myself, so I don't have a management expense. And I say, well, that's fine and dandy. So if I buy this property from you, will you manage it for me for free, into perpetuity? Because that's basically what they're asking you to do. So we'll plug that in. Then we look at real estate taxes. The other thing that's important too is we look at the real estate taxes, and let's say this thing's assessed for $100,000 and this thing's sale pending for $200,000. More than likely, there's going to be a change in that assessment in the future. So we consider that either by doing a loaded cap rate technique, or we look at it through going to some assessment comparables, looking around the area, trying to find a few other ones that have maybe sold. Like what I'll do is look at my sales using the sales comparison approach. Hey, what was the assessment on these things before they sold? What was the assessment after they sold? Did that change? So I can use that as a focus. Hey, you know what, this assessment, yeah, it's sale pending for 200,000. It's assessed at 100,000. Maybe the assessment of these other ones went up to 150. So that's what we think this is going to be. So we use that for, in our pro forma. Then typically what I'll do is, get, all the average utilities, insurance, and then other expenses, lawn, snow, trash, typical maintenance. And then we also typically apply a reserve requirement, which can be anywhere from $150 to $400 a unit. And I look at that based upon, the age of the property, how well it's been maintained. If they've, once again, if they've had any major CapEx expenditures, like, hey, we put a new roof, we put a new boiler in it, we did, all new windows, because a lot of those items that be in that reserve requirement, you can justify a lower reserve rate because of that. So that gets us down to our NOI. Next slide, please. Oh, I think one more. Okay, so now we've got our NOI. You can look at several properties, and what I try and do is track cap rates, extracted cap rates from properties. I'll look at extracted cap rates I like the best. We also look at, places like realtyrates.com, RERC, those are more kind of national, cap rate extractions. We look at those as well, but I really prefer to use ones that are extracted cap rates from the market. Next slide, please. Okay, like I said, we've still seen a decline in cap rates just due to the shortage and the cheap cost of borrowing right now. Some of the higher ones we've seen are 8 caps. Those are maybe kind of secondary, third locations, properties that have not been as updated or maybe a little bit more management intensive. Some of the 5s, we're talking, downtown, there's not a lot of 5s, but, might be something that's new construction or, very well located, or new construction is very well located. And some of that also plays in sometimes with some 1031 projects. We don't really see any changes we're projecting in the cap rates right now, unless something major changes, interest rates go up to 6 or 7%. But if that happens, we've got bigger problems than just cap rates. Next slide, please. So here's kind of a list of some of the extracted cap rates we've seen in the Iowa City market in the last couple of years. Obviously, a couple of those lower ones, like in the 5s, those are, some new constructions, or, some of them have been 1031 deals, or even some, you look at the cap rate. Okay, this thing's a lower cap rate. They think maybe there's some upward potential in rent movement. So, your terminal cap rate should be higher. Next slide, please. Okay, so just kind of what we're seeing with cap rate movement, overall, market, there's shortage. I do see some concern. We've seen that with, applying, a little bit higher vacancies, some of the student housing, just some of the uncertainty with quite frankly, with the COVID and with the, university enrollment has, started to stabilize, but it's been declining. New construction starts have been going up. There's just some little bit of uncertainty and some concern, in the student housing segment. Going out towards the Coralville area, some of the new construction over there, that's been pretty stable. That stuff's been absorbing very well. Not as concerned about that segment. Just looking at that growth along 965, we're seeing that, be positive, to continue. Next slide, please. Okay, I guess questions.
I have a question. I'll be the first one to jump in.
All right.
And I would be kind of curious if anyone else wants to jump in on this conversation, because I'd be kind of curious to see what others are seeing other than just me. And I'm throwing maybe a couple of bankers under the bus here. So if you have any opinion, obviously we see stuff that hits the market more often. I mean, if an agent's looking at it, it's probably because it's through the MLS. Love to get the stuff that's not on the MLS, but that's what we're looking at. A lot of times, I do my own analysis, and all intents and purposes, I believe it's accurate. And when I go look at it, typically the first thing an agent's going to do to make their numbers look better, and I'm sure you see the spot, John, is they're going to take out management, they're going to take out reserves, and all of a sudden now their cap rate's a little bit more in line where it needs to be. Now, obviously, that's not probably a true cap rate because it's missing 2 key line items. But my question is, I've been seeing it for years, and maybe I'm just doing a bad job. Maybe it's just a bad agent, but I see, stuff that hits the MLS on the multifamily side. I'm like, this just doesn't make any sense. When I actually take and extrapolate the numbers that are probably more accurate in line with what should be, add in those management, add in the reserves, and then like, I don't even forward on to potential buyers. I'm like, this doesn't make any sense. It's a negative cash flow or something's wrong. And then 2 weeks later, it's pending, it's contingent or under offer. Now, there's some 1031 exchange people out there, but are you getting, I mean, from your perspective, not getting in trouble, are you seeing offers come in that you're like, I don't get it, this doesn't make sense, but not a lot, huh?
Not a lot of those, but we do see that from time to time, or, the person starts doing their due diligence, we do the due diligence, and sometimes the listing agent, has the omission in there, or quite frankly, they're going off what the sellers provided to them.
Yeah.
So they say, this is what we believe to be true and accurate. So, it is what it is. But yeah, we're seeing that. And that's, kind of the difference between, you'll see cap rate differences. My cap rate, I might be talking a 6.5 cap, like you see some of those in the market, where somebody else may say, well, that's a 7.25. But you're absolutely right. We've seen some challenges and disconnects on that. this made our job somewhat difficult sometimes, and sometimes we have to have that tough conversation, kind of like I spoke to too on that. Hey, you've got to have management, you've got to have snow lawn. The best one's the guy that's got the fourplex that says, well, I do my own management, I do my own snow and lawn and all this. I'm like, well, that's great, so you'll do that for me for free forever. Well, no, that's the disconnect we see. And but yeah, I mean, I'm with you. Or people just, they have the mentality, they don't consider the cash on cash return. They say, well, this thing's cash flowing, I'm making my payments. They don't consider what they've got to get for that cash on cash return.
I have a
So
similar question in with Mark. Just my name is Nicole, and as I work with agents in different cities or different states, and I'm fairly new, so I completely admit my naivete or my newness, but other agents will often comment on how Iowa City finds their cap rates. They're like, you guys are just including insurance, taxes, and fixed cost, like lawn mowing or snow, but no one, not no one, but like we don't very often see people who are doing those typical maintenance. What are you calling typical? Like, how would you define typical maintenance? Because I definitely want to adjust how I figure my cap rates.
we typically will, we look at some of that maintenance on the age of the property. Has anything else been done to it that's, we need to consider, like it's going to need a roof pretty soon. Where are we at with this thing? Is it going to need a boiler pretty soon? We look at a lot of those things. What all does this thing need?
Can you be like a little more specific? So like,
sure.
Because like, I love how you broke it down that the unit, cost per unit, I can't remember what the word was you used, but that depended on that. Mark used the word, what is it? It was like 150 to 400. What was the word you used?
The reserves required.
Yes, reserves. Thank you.
Yeah. So like,
I wish the typical maintenance, do you have like a set number, or if it's, oh, it needs a new roof, I'm going to put 10,000 and divide that by 3. Like, do you understand what I'm saying? Can you be a little more specific?
Yeah. So, you can look, so if you know this thing needs a new roof and it's going to be 10,000 for that new roof, for example. Okay. And we know that roofs 5 years out, you look at it's like a sinking fund or replacement reserve or something like that, typically you should have been putting away for before. Or if it's like a 1980s built apartment that, hey, this thing's going to need just more maintenance and reserves in general, you'd go towards that upper end of that range. Or if it's something that's brand new construction, hey, this thing's, pretty low reserves, maybe $150, $200 a unit per year for reserves, because it's got all new roof, new HVAC, new carpeting, all those types of things. So that reserves typically any, replacement things like would be carpet, HVAC, roof, parking lot, some type of soft remodel at some point. Did that answer your question? I hope.
I don't
sort of.
So, no, that's okay. And it's probably, I'll call Mark later. I guess, so like, do you count in, because like one agent's like, I want to know how many times they had repaired a toilet. Like, I want all of those expenses, maintenance expenses included in for a cap rate. Was saying, this is how this agent was saying, do you do that?
So we typically figure like an average maintenance per year. I'll try and look at, like, maybe if I've got a property, 3 or 4 other properties that, I've looked at that I get. That's why I asked for those 3 years of historicals, because like, so there may be one year where you've got to go out and fix, plumbing on 4 units, and you may never touch that again for the, 2 years. So we look at just the average maintenance expense for that property. So if you're looking at maintenance, not reserve items, maintenance maybe, hey, we got to go out and, fix a charging air conditioning unit, or, or we may have to, fix some plumbing, or we may have some drywall repairs, or, some of those things like that. And that's why I like to look at, like, that's why I asked for, like, hey, can I see 3 years of history, please? That way I know, or what I'll look at too is like, wow, this thing's, cost of $1,100 a year in reserves, or in maintenance. And most of these units like this I'm seeing are, $700 or $800. What's going on here? But that's also what I'll do too is, those historicals are really important on that property, but I'll say, hey, here's the historicals. Here's 2 or 3 other properties I have in my office files that are showing rent, that are, expense comparables, and they might be, $600 to $700 a year. So I'm going to say that this thing really should be $600 or $700 a year, unless I have some reason to know why that's not applicable. And I usually talk at that point, I'll talk to the banker or I'll talk to the borrower, client, or talk to both of them, say, hey, here's what I'm seeing. I'm missing something, because I don't want to overstate or understate a value. So, like I said, that's what I really try and look at to make sure we're applying that right. Okay.
So John, we always have the listing agent, and I can be one of those to blame for this, but you look at potential value versus historical value. And a lot of times, somebody's not maintaining the property. A lot of times they're not raising the rents. And for the investor, if I'm working with a buyer, I may be presenting to them, but here's the historical numbers. Here's the low rents, but here's the potential value upside. And there's many times where a seller is not willing to sell their property for a cap rate based solely on current historical documentation, where they're looking at potential value. How do you deal with that as an appraiser?
Well, that's a great question. I touched a little bit on that in the discussion there. I will say, hey, if I've got one that all the rents are, let's say $500 and they should be 1,000, I'm just using that for just easy math. Say, here's our current rent roll, and I include that in the report, because if you don't include that, then you're being misleading. But then you use your market rent comparables and saying, this thing really should be $1,000 a month units. And, most investors, most leases are, 12-month leases or less. And most time when you're doing this, you're partway into that. So you say, I assume when these leases, get renewed, they'll roll over to, market rent. So I will do my pro forma based upon what the market rent should be on the property. Same way with some of the expenses. The expenses are too high or too low. I'll say, here's what the actual is that I was provided. Here's what we project it to be. And then I apply it. But I'm very clear that, here's what it is, and here's what's performing now. But it's also not right to take a cap rate and, take that, income and cap it, because then you've capped that into perpetuity, which would be a below market lease or above, market expenses. Or, if you've got an above market lease, if somebody's got something rented for $1,500 a month, for short-term leases for a year, but it really should be 1,000, you need to, same way you need to adjust it. So that's why we try and look at all that and analyze that and say, here's what it is, but here's what we think it should be, and here's why. Did that answer your question?
Well, how do the bankers deal with that when you've got a financing approval on it, and they're looking at, no, I got to have it based on current expenses, and you got a buyer that is, well, wait a minute, banker, I'm going to raise the rents the minute I buy it. My income's going to go up 25%. How are the bankers dealing with this?
That'd be a good question for them. Typically, they're going to look at debt service coverage ratio, as you know. So they should, there should be that discussion with the bank saying, hey, this thing, the NOI at the end of the day is either too high or too low. Here's what we think it should be going forward. Because they're caring about, future, debt repayment cash flow. So they should be, I would think that, they should look at it and say, okay, we're going to look at this thing, what should be moving forward, not what it is currently. Have you run into that problem where the bank says, well, this is what we've got, so this is what we can do? How have you seen that? Have you run into that problem?
Yeah, I've ran into, I ran into it on both sides of the fence.
Okay.
If the bank is dealing with an experienced investor, they kind of let the experienced investor kind of run with things.
Sure.
When the bank knows they have a novice investor, the bank gets pretty tight.
Sure.
They get more conservative. And I think that's the right approach.
Yeah, the risk mitigation.
If you've got an experienced investor who knows, I'm going to buy this and I'm going to raise some rents, and I'm going to cut the expenses. These taxes are out of line because nobody's ever went in and argued with the assessor, and they know how to do that. I know one guy that's a CCIM nationally, does 4 deals a year. And all he does is go find properties that are overtaxed.
Mhm.
And then he gets them, he buys them, so, and then gets them all fixed up with the new expenses. And then he goes and sells them and flips them. The guy does pretty good, and he does 4 deals a year.
I like that. That sounds like a good deal.
Yeah.
But that's also kind of, my comment on the taxes too. Part of our, we got to evaluate the real estate taxes and the assessment. How does that impact this property? Because if you've got something that's, assessed at 100,000, selling for 200,000, you at least have to have that discussion. Do we think these taxes are going to move up, or do we think they're not going to move up? So where does that end up, and then impact our, our pro forma and our cash flow? So, and that's part of what we do, and we're looking at in the appraisal, we analyze that, and the best of our knowledge and what we can see right now, this is what we think is going to happen. And typically I'll call the assessor up. I won't identify the property, just from a confidentiality standpoint. Say, hey, I'm looking at this, how are you guys seeing this? Or do you have any assessment comparables? Because the assessor kind of gets to that point too, where if they've got too many sales that are, well above what their assessed value is, they get a state order an increase. And that's no fun for anybody. So then we all got to go back, then we all got to go and start fighting the assessments.
John,
Yep.
that cap rate extraction you shared,
Yeah.
you went through, it's something I've never seen. It's kind of neat. Is that not getting you in trouble because it might be proprietary, but is that something you can share in the future? And I say that with an asterisk because, I know some of these properties, and obviously there's a story behind each one, right? So it's not just, it's a range, right?
Right. And so
there's the reason some have higher cap rates and some have lower. There's a lot more data that's not shown here, but it's still kind of neat.
Yeah, so typically what we do with those is, and that cap rates after we extract out, vacancy management, all the expenses, reserve. That's what we're looking at as an NOI, bottom line NOI divided by the sales price. So that's how we get that cap rate. Some of those cap rates, like, wow, that's kind of a little bit lower than what I thought it'd be, but that's kind of back to the point too with if people are extracting things out, and that's why I like looking at cap rate and going through the NOI versus doing a gross income multiplier. But yeah, I have no problem. If anybody ever needs anything, I mean, I tell everybody that I'd rather have a discussion. Hey, what do you see in the market? Here's what I'm seeing. And I call on brokers all the time too. Hey, what's the deal with this project, or what have you seen? Am I missing something? But yeah, I'm always glad to share that information. I mean, some of the stuff that that is confidential. Obviously, I can or I can't say here's the exact numbers on this, but that's why I kind of did. Here's kind of a broad, extracted cap rates for and I tried to kind of pick a wide variety of the market segment when I put those cap rates in there. So, but yeah, I'm always glad to help on that. And the other interesting thing too is you looking at some of those where I've looked at the same property 3 or 4 times, and it's maybe traded hands 2 or 3 times, and how that cap rate's changed or it hasn't changed. And then if that has changed, why? What's going on? Has it been? Did they do a renovation, or did they? It's just the market had that much of a swing and change. So that's kind of what we're looking on that. But yeah, I'd be glad to share that. And like I said, if you want any of the slides or whatever, send it over. Whatever you guys need, let me know. Glad to help. Anybody else? Any other questions? I don't think so. Is that
Kind of quiet out there.
Yeah. Everybody's on mute.
Yeah. No, well, thank you for your time. This is really helpful. It's kind of nice to get another perspective on, especially on the multifamily side, because a lot of us are one agent human beings. So it's nice to have a broader view. So
yeah, there's a lot of moving parts in these things, and I definitely appreciate what you guys have to go through from your perspective, and you've got the balance of you know, getting the property listed, making sure you've got everything, you know, getting it sold and keeping your client happy as well. And, you know, sometimes I said, some people, you know, they'll ask us or they'll say, God, your cap rate's a 7 and I'm advertising this thing at a 10, kind of like we talked about earlier, you know, so, you know, what all are you carving out? Are we all at the same, you know, equal playing field, you know, on this thing? Are we at the same, you know, bottom line net number?
Yeah,
So,
I appreciate it. That's awesome. It's helpful.
yeah. Well, I really appreciate you guys and time everybody's taken today to listen to me and, you know, kind of share what we've got for our insight. I know it's a little bit quick, but, you know, like I said, once again, if anybody's got any questions, by all means, let me know. I think on that PowerPoint slide's got my email and my cell. So if somebody wants something or needs something, just let me know. Glad to help. So thanks for your time today.
Yeah, appreciate it, John. Thank you.
Thank you. Thanks.
Thanks.
Thank you, everyone.